Todd Langford, welcome back to the BetterWealth Show.
Hi, thanks for having me.
We did a video that was posted about a month ago saying responding to hard objections against whole life insurance, and we got a whole lot more objections in that video. I'm trying to think, did we accomplish what we wanted to do? Yes, because we're increasing conversation in this space, and so the I could almost summarize all these comments that we're getting by pretty much saying there's almost two paths. Path number one is people are challenging the numbers, and there are people that don't know us that are saying this is a scammy way to life insurance salespeople trying to position insurance, and they're using numbers like fees and taxes to elevate insurance. And so that's on one side, and it's laughable to people that know, especially you. The last thing I would say is a salesperson. That's probably critiqued on the other side. You probably should be more of a salesperson in the areas, but you're just not because you're in the numbers. So that's on one side. And then the other side are the people that are just saying like, hey, listen, you're not comparing this properly. Like, why aren't you just putting your money and paying no fees and no taxes and like why are you like that's what you should do. Like that's just another reason why insurance has no place in someone's financial life. What I took away from that is there is still a very, very deep misunderstanding when we talk about insurance. I think there's such a misunderstanding about the either or. You should do
Yeah.
insurance or you should invest in this. And I think we've had other videos where we're talking about insurance as an and, we're talking about insurance in distribution, we're talking about the other benefits that in life insurance gives you. And my thought process is insurance, even for the person that wants to do it themselves, doesn't want a manager on anything. Insurance, when set up and used properly, could still be a benefit to that person if we're talking about the right outcomes and goals. And most people, successful people, aren't going to do it themselves. So they're already going to work with somebody. And so whether our assumptions were right or wrong, like it's not wrong to bake in some cost to having help manage your stuff. So with that intro, I'm just going to hand it over to you. There's a lot of places that we can go. I want to encourage you, the viewer, like we're not going to answer all the questions. There's probably going to continue to be questions that come up. And I have a series that I've done with Todd, and we'll try to make that as easy as possible to go through. But life insurance, for better or worse, is multidimensional. It's not like you do this because this is the only benefit. And so sometimes when you get a multidimensional asset, there's other benefits that are hard to quantify, and we're going to do our best to bring those up. But I'm sure we're not going to cover it all, and that's why I have more than one video with you, Todd. So maybe the world's longest intro to our series, but without further ado, welcome, and I look forward to learning.
Thanks. Well, boy, there was a lot of stuff you opened up there in that front end, right? And I think one of the big ones is trying to understand there's no way we can hit what everybody does. We're looking at the general public just as this is what most people do. This is the way it is for most, and there's always going to be exceptions. I mean, you could throw out, what if we invested in cryptocurrency and it doubled every year from now on? Well, okay, nothing's going to beat that, right? But it's not about that. It's about looking at that big picture and seeing how everything fits. And I think one of the mistakes that I made was not really enforcing the idea that life insurance is not an investment vehicle. It's a savings vehicle, and it becomes part of a portfolio of investments. It becomes that certainty portion that gives us access to emergency opportunity fund capabilities when either an emergency comes along that could totally knock us out, or when an opportunity comes along and we need to be in a position of cash to take care of it. Typically, our investment side is going to be locked up for longer periods of time to where those kind of fluctuations really hurt our long-term returns, right? And we hear people say, as long as you're invested in the market for the long haul, the lows are going to be fixed by the ups along the way, and the ups are going to be maintained by some lows that are going to happen. Well, the problem is we don't know when that sequencing of returns is going to occur, right? And so for most people, we have to have something to buffer that, right? We have to have some cash assets, and in a managed portfolio, using modern portfolio theory, which has been around since the 50s and kind of adopted across the financial industry, is an idea of a balance between stocks and bonds, so that when one's up, the other one's down, and they kind of help to balance each other. And it gives us, if it's short-term bonds, a place where we can pull dollars when we need to. And so think about this: if the marketplace, and we've put all our money in the market, and all of a sudden we have a downturn in the market, and we have an emergency that occurs, and we have to have cash. If we liquidate cash in that down market, we've totally destroyed the average of that return over time. We've given up the ability to have those rebound when the market goes back up. And so we need other assets. And I think for a lot of people, if it's a managed portfolio, it's going to be balanced inside of the portfolio. If somebody one-on-one doing it, typically, if they're really looking at the big picture, they're going to have money sitting in cash somewhere to buffer that, right? And so they don't often include the cash in the overall decision. But really, if you think about it, because we put money in an investment somewhere, whether it's real estate, whether it's market, whatever it is, subconsciously, we're also putting money in a cash position. And that really needs to be included, because it was that decision of the investment that caused us to sit in cash, right?
Yeah.
Or whatever that is. And so really, life insurance plays a role to be that cash or certainty asset, and it really expands things. Now, when you look at the big picture, and that's what we did, and that was my mistake, is looking at, hey,
Todd,
here's the return.
Todd, can I stop you right there? Because you said something that is really, really important, and I'm going to expand on that. So
Sure,
you said
right.
that a lot of times when people compare things, they're just looking at their highlight reel. They're just looking at maybe the S&P or their investments, but they're failing to say, well, you have $50,000 in a savings account over here, or you have money stashed over here. And so they're not necessarily bundling that together and including that in the rate of return. So that's first and foremost. But then when you stack that on top of a protection asset or a protection product, who factors in insurance products to factor in opportunity cost and rate of return? So for example, that same person that's now buying disability income insurance or term insurance, really, if we're going to compare more of an apples to apples comparison, need to include those premiums as well, because when we're talking, and if you're using a permanent product, you can use other benefits that you don't get in a savings account or an investment. And so that is just like most people skip over that, but it's really, really important to like start looking and comparing benefits to benefits. And so just continue. But you said that is very profound. A lot of people miss it because most people talk about their investment returns, fail to bundle in their safe assets, even if it's a savings account, and really fail to and overlook the opportunity cost of putting their money in other insurance products.
Right. And so part of that, life insurance got a reputation of being a terrible investment. It's because it's usually not apples to apples without looking at that macro look, stepping back and saying, how does all this integrate? And it's really a critical piece if our goal is to get ahead. If all we want to do is focus on the ups, and that's all we care about, then you should have everything you have in those ups, right? No money anywhere else. Well, that's not going to work very well if life is life, right? It throws obstacles at us. We have issues that don't go according to plan. And the way to mitigate that risk is to have other pieces in place. Well, life insurance, turns out, it's got a lot of those pieces built into one product, right? And so with everything else, we do have to look out there and see what those are. What does that term insurance cost? You mentioned disability. That's an important piece. Does your plan of investing complete in the event of your disability, right? I don't know any plan out there outside of life insurance that has that capability where the premiums will get paid in the event of a total disability if you have that waiver of premium rider on that life insurance policy. So there's so much bigger picture that needs to be talked about. And when we break it down to just the micro, like I say, we should probably, if we look at what the returns on crypto have been, we should probably dump everything in crypto and just hope for the best. Well, I don't think a lot of people would view that as a very safe journey into the future. Not to say you may not want some, and I think it's going to depend on the individual too of where those investments are. If that investment doesn't really fit your personality or what your goals in life are, I think that's also a mistake. I've seen it happen with client after client on the real estate side. Real estate gets popular. Everybody says get real estate. Robert Kiyosaki, big real estate guy. Well, real estate fits his DNA, if we want to talk about it like that, right? He knows how to manage it and how it worked, and it was very successful for him. But people who don't know anything about real estate or don't like it, just investing in it for the money, they're probably not going to make any money off of it, even though somebody with the same real estate could, if it's in their DNA for that particular investment. So that also needs to be part of the picture. How does it fit your lifestyle and who you are, right?
Right.
So, it's interesting when we look at the marketplace. So even I saw a recent article about Warren Buffett. And Warren Buffett, the big investor guru, right? Nobody's better than Berkshire Hathaway. And he's always been a big 90-10 kind of a person, 10% bonds, 90% stocks. Recently, the portfolio has pushed up, and what I saw, it just crept over 50% in bonds, and all short-term bonds. Now, why short-term bonds? He will not use long-term bonds. At least that's his current position. And the reason is because he wants access to cash, right? And those long-term bonds really take a hit if you liquidate them early. And so those short-term bonds, he knows he's always in a position of cash, even though the returns on those short-term bonds are not going to be nearly as good as they would be on long-term bonds. But again, that balances that portfolio. And so that's public record. We can see what's going on there. And again, it all goes back to being in balance in what our overall goals are. And, something that we've talked about before, and that's being able to spend those dollars. So it's not just the accumulation side. Something that also needs to be in our mind is, why are we saving money? Why not spend it all today? And for most people, it's the only reason they want to save money is for the future and be able to spend those dollars doing it during a distribution phase. Spend those dollars when we decide we don't want to go to work every day, right? And so if that's what we're doing, then we really need to have it in our back of our mind as to how spendable those dollars are going to be out in the future. How do we set ourselves up in balance in what we're doing so that we have an optimal way of spending those dollars? And it turns out that we may have less dollars that could provide more income based on where they are and based on the other protections or certainty that we have around that, than having more dollars locked up in a place that's a little more risky.
Yep. An example of that could be, you could put all your money in the S&P or do your thing and have a greater quote unquote nest egg potentially. And we say potentially because we don't know what the future looks like. That could be
Right.
a bad accumulation strategy depending on what years you want to quote unquote retire. But let's say you have a higher net worth and nest egg versus maybe someone who, I won't even use insurance, just has a more diversified portfolio. You might have less money in that portfolio, but that portfolio that's smaller could kick out more income because it has a better, stronger, more diversified foundation than the person that has all their eggs in one equity basket. And so that's an example of, we got to think with the end in mind, and anyone that's saving to invest is deferring consumption today to consume in the future, whether it's themselves or their children or their grandchildren. You're deferring consumption for a future date. And so our hope is that we get a return on that deferral, and so it's just, we just have to think with the end in mind. It's rate of return is a measurement, but that might not transfer into cash flow in the future, because a higher rate of return doesn't necessarily mean that you're going to get the highest cash flow guaranteed in the future. And so where do you want to go from here, Todd? I know that there's a lot of comments. And like I said, in the two buckets, there was like people that were really criticizing the fees that we used and the tax rate. And so I don't know if we want to start there and kind of talk why we did that, or I also open to say let's just even take their assumptions. Let's just say they're right. Let's play like, does life insurance work even if you're not paying any fees? Like, could you still justify insurance if you were managing your own portfolio? And I think if in this video, if we can touch on both of those, we would at least accomplish what we've set out to accomplish in this video, to try to set the record straight. Not everyone's going to agree with us, but at least people can kind of hopefully understand maybe where we're coming from for why we're a big fan of insurance.
Sure. Well, and what happens is it's that integration that really makes it the best of all worlds, right? We're not saying one or the other. Let's see what the big picture integration of all those pieces do together. And while life insurance, we talked about it not being the investment side, it is a great bond replacement. So that certainty side that we're talking about, the bonds that Warren Buffett's leaning on, the cash that a lot of people hold on to in real estate investing to make sure that, if they lose a roof, they have a way to put it back on, or if they have some vacancies, they can still make their mortgage payments across that time frame until things get straightened out. So it's that cash or certainty piece that life insurance plays a great role in, while providing additional benefits that we wouldn't get from those other more typical types of certainty assets. Does that make sense?
Yes, it does.
Okay, so let's kind of dig in with that, and we'll take a look at it and see what we can do. And we're going to look over the last 30 years here. Let's use the S&P with dividends, the best of the best, and let's put a 60-40 portfolio in here. So at 60% S&P, and it's averaged 11.7 over the last 30 years, as we can see there. But let's compare that with, if we look at what Warren Buffett's done, let's use 1-year treasuries, because he needs access to cash, right?
Yeah.
If we look at it in that scenario, what we see now on the far right, that's a combination, that's that 60-40 portfolio. And it shows an 8.06% return across this time frame. Now that assumes no taxes and no fees anywhere. Let's turn on taxes for just a minute, and I need to clarify a couple of things. So if we look at the S&P side, a lot of people think if they buy into the S&P, they don't pay any taxes. They do. What happens is the S&P, to maintain its returns, they reconstitute the allocation of the different stocks in there. When you do that, those buys and sells create a tax issue, right? And it's been fairly low as to what's happened. Some of it's going to be at capital gains rates if the stocks that are being sold have been held for longer than a year, or it's going to be at regular income tax rates. Not the whole portfolio gets overturned. In fact, with the S&P, there's not a lot of amount that gets reconstituted over time. But let's just use a 10% tax bracket, because only a portion of it and only at smaller amounts on the tax side. And if we do that, that moves us down to an overall of 7.16%. Looking at that, and I'm going to assume no fees on the S&P at all. I know some people say, hey, we can do it with 0.04%. Whatever, let's just not use any. And when we did our example before, we were kind of talking about using the S&P as just a guide, and not that anybody was actually investing in the S&P, but they had a portfolio manager that was following somewhere close to what the S&P was doing and generating some tax. But let's just not have any management fee on this. So totally self-managed, right?
Yeah.
All right. And now then on the bond side, let's put a tax bracket of 24%. And let's put a management fee of just 1 point. And what we see now is an overall 6.5%. So doing those ups and downs, and what we're going to see in a life insurance policy is only somewhere probably around 4 to 4.5% with current dividends. We've been experiencing the lowest dividend time in history over the last 20, 30 years. So that's fine. We'll just assume that that goes out in the future, which is also kind of an interesting thing. What happens is people typically want to use the history of what's happened in an investment index. And yet with life insurance, they want to use that as whatever the return is from now, assuming it stays that out into the future without getting credit for the high returns we had in the past. But that's okay, right? The thing about it is it's a certainty vehicle that we can see falls, short of the 6.5%, certainly as an overall. But what we're saying is not to replace the whole portfolio with life insurance, but what if I get rid of those bonds and shift that to life insurance?
Yep.
But before I do that, what if somebody's sitting in cash? What if somebody did it themselves? They said, well, I don't buy bonds, but instead I've got cash sitting here. So let's first switch this to fixed. And let's say somebody was doing 2% on their savings account overall, combination of checking and savings, and they wouldn't have a management fee on it. Still going to have tax on it. That would actually push them up a little bit over the treasuries, right? But what if we use life insurance for that portion? So let's switch that fixed to 4%, and let's get rid of the taxes. And now we're up to 7.71. So it's a combination of those two, and we're using the life insurance as the certainty portion so that when that emergency comes along, we don't have to hope that it only happens when the market's up.
Yep.
That if the market's down, we have a source of cash to lean on to get us through those tough times. Or more importantly, I think, is when a great opportunity comes along, we don't have to sell that performing investment to take advantage of another opportunity. Instead, we can lean on our cash that we have sitting there to take care of that piece. And so that really works, in my mind, to a much better piece when we're doing the accumulation phase. And not only did we get a better return, but we picked up tremendous benefits, right? And that's a piece like we were talking about early on, is that integration and looking at the overall, not just the overall portfolio, not focused on just the investments, but our overall financial picture. Because what we've also picked up here is a life insurance death benefit, meaning, right, we wouldn't have to have term insurance to have, to be able to protect our family as if we were just in the market and bonds, we would have to. We also pick up something that's, it's hard to compare, but included in that return is a waiver of premium disability benefit, where the insurance company will actually pay the premiums for us if we are completely disabled. Now, for most people, let's say they have the best disability insurance they can have, right? It's going to cover maybe 60% of their income, depending on what profession they're in, et cetera, et cetera. But let's say they had 60% coverage. Well, if you dropped just 60% of your income overnight because of a disability, what is the chance you're going to be able to continue saving for the future? Right?
Very low.
That portion's going to go away. Now that you haven't saved for the future. Well, here's the scenario if we have life insurance as part of the base. With life insurance in place, with a waiver of premium benefit rider, what happens is you become totally disabled, your income drops to 60%, but the life insurance company now is going to pay those premiums so that your savings piece continues to happen. Now, that's not available in other types of investing and saving, and so we really can't compare that to something else, but that's an additional benefit in there that shows that our likelihood of being where we want to be in the future has a higher percentage of actually happening, right?
Yep.
And I think for most people, they've been tuned to an idea with insurance or just protection in general is protection is going to be a cost against my wealth production. But if it's integrated correctly, they can both actually be on the same parallel path to where we can achieve both and get out there in the future as long as we allocate it correctly and look at that big picture so we know what's going on. And that actually sets us up in a position to be able to better spend the assets out there in the future. Yep. And, we mentioned that. Did you have a comment on that?
I mean, I always have a comment, Todd. That's
Great.
the a couple of things. I love the word integrated, but if we just go back to, okay, we looked at a savings account and we gave 2%. Some people might say, well, savings accounts will earn more than 2% right now. We're looking at over 30 years, and so it would be very dishonest of us to try to, assume today's interest rates are going to happen for the last 30 years or the next 30 years. So use 2%. And you could argue, anyone that follows this channel or understands, how life insurance can be set up, is you have liquidity. That's something that not everyone understands, but like, you have liquidity, you have access to capital. That's a benefit, and it earns greater than a savings account. So like, that's check. When it comes to a bond, literally, with long-term performance of insurance, just internal rate of return, and then when you eliminate the taxes, and it's already built in the quote unquote fee that you would have to pay on a bond, like, insurance is just a better bond. I would love if someone wants to challenge that. You're welcome on the show anytime to literally show me why bonds would be better for someone's portfolio in the short term and long term than life insurance. I would love to have that conversation. I think the fact that no one has hit us up yet kind of tells you that point. And so you look at those two things, but then what you just did is, now you stack on all the other benefits, the death benefit, which is included, and by the way, does not represent in that 7.7% that we're not incorporating the death benefit in that. We're not incorporating the waiver of premium in that. We're not incorporating this thing called chronic illness and accelerated death benefit riders in that. We're not including the type of creditor protection in that. We're not including the life insurance potentially could be way more certain than other bonds. We're not including all those other things. And yet, in this example, you're actually showing that they get a greater growth rate than other areas. I think you could even go as far as to say, even if you didn't get a greater growth rate, the reason why we save and invest to begin with, which maybe we'll touch on, but the fact that it's even close, and then you get way better benefits and a better future because of all the other benefits you get, should be like a no-brainer for people to understand why life insurance would be a part of your portfolio. No, we're not trying to bash anything else in talking about this. We're just saying it should potentially be a part of your portfolio. So those are my comments. I love the word integrated, and I think that should be something that, regardless of who you are, you should figure out how you can integrate more benefits and give yourself more benefits in what you're doing.
Yeah, it's really pretty interesting. So, I'm not going to suggest to anybody to do anything that I wouldn't do for myself. We talked about real estate earlier. I played with real estate. I know real estate doesn't fit who I am. I learned that the hard way. And so I'm looking at what I would like to happen for me. And that's what I talk about. And if we're looking out there in the future, you really hit the nail on the head. Look, we actually improved the portfolio overall by doing this, and we added the additional certainty benefits that are going to make that happen, or more likely to happen out in the future. And personally, I would rather have 90% of what I could have elsewhere is a possibility. To know that that's more certain to happen than, some chance of having more than that, right? A chance of hitting 100% with a likelihood of far less than that, right? Yeah. Because we're not set up properly. And the thing about it is, we don't know what's going to happen. I learned a new term at a conference I was at recently. We've talked before about black swans on some of our black swan events, right? On some of our videos. But there's a gray swan. Are you familiar with that?
I'm not.
No. So gray swan events are really interesting. So where black swan events are events we didn't know were going to happen, and we didn't know what they were, right? We couldn't even have an idea of what it was, like COVID is an example, and that's actually becoming more of a gray swan, and I'll explain that. But like 9/11, right? We had no idea that was going to happen, or anything like that. A major terrorist attack inside the United States, right? So totally off the charts. That's black swan events. But gray swan events are events that are likely to happen, but we don't know for sure they're going to happen to you. An example, 50% of marriages end in divorce. Okay, so there's a likelihood of a gray swan event because it's got a 50% chance. Here's something interesting that I heard. I haven't checked it up to make sure it's, I haven't seen the actual numbers or stats myself. I just had heard this, that number actually goes up, I think, to 60% if your wedding costs more than $10,000.
Oh boy, that's not good for me. How is that even possible these days? Like we're not heavy spenders, but that's tough to do.
Right. Yep. So it's just kind of an interesting thing, though. So there's these gray swan events that there's a high percentage of likelihood that these are going to happen, and they may or may not. But the point is, if one of those events has the potential to totally derail,
Yeah.
what we have, then the fact that we had a chance of having more in the future just got blown out, right? Yeah. I would rather have something in place that even if those events occur, I can wiggle and be close to what my target goals were.
Yeah,
right?
That's really good. There's probably a mathematical simulation that we could do when you start, because I just wrote the disability as well when you were talking about gray swans, because it's easy to like look at these and it's like, I don't know exactly what the stat is today, but it's like 1 in 3 or like, and but people never think of themselves. They're like, well, I'm never going to get disabled or like, this is never going to happen to me, or like premature death. God forbid, but people do die prematurely. And when you start adding up all the gray swan events and you put that into a simulation of what's the possibility of divorce, this, disabled, all this stuff, it would be pretty interesting to see the likelihood of, that happening, how many times happening, and I'm sure there's like severe gray swans like premature death and maybe less severe ones. But it would just be interesting to get people to start thinking of like that mentality, which I appreciate you bringing up, because you brought up just divorce, which is a huge, but that's just one gray swan out of many that we could be navigating in our lifetime.
Right. And so we know when we can look into the past for people that, have been in the workforce for a while. You can look back and say, well, not everything went exactly like I thought it was going to. Is that likely to happen that same track into the future? You mentioned disability and you were right. I think it's 1 in 3 have a chance of being disabled for 6 months or more, but it's like 14% of people have a likelihood of at least one 35-month disability or more. If we could cover the downside of that without it costing us on the upside, that's a win-win. But the only way we know to do that is when everything is looked at and how everything fits together. If we just take one asset and compare, if I put everything in the S&P or cryptocurrency and versus putting money in life insurance, that's a terrible comparison. And you're right, life insurance is not going to do what that would do if that does what you think it's going to do. How's that?
Yeah, I'll have to re-listen to that. But yes, I'll take your word on that. Made sense. Yeah, I'm just thinking out loud here. It would be a really interesting calculator to look at different variables, and we could pull in the statistics of what that happens and almost be like, okay, you have strategy A versus strategy B, and we lay it out and try to be as fair as possible, but then we take the different black swans and gray swan events and we see like, what would be the reality if this thing happened and this thing happened. And it would be interesting for clients to be able to see, like, you click this one box and boom, like this is what the current strategy looks like. It could be like a 50% loss in the market. How likely is that? I don't know, but that could very much, that could happen. I'm not saying it will, but it could happen. History has shown that something like that could happen. So it's like, it would just be interesting to start seeing like the different scenarios. And what you'll find is what we're talking about will stand stand stronger uh, in the midst of a lot of those. Hence, so there's a lot of things I could say. I don't want to
Yeah.
detach from what we were talking about, but I think it is important to give a little bit of context.
Well, and we've started looking at that. Actually, in one of the calculators I have, I think we've shown before, the max potential calculator, I have the ability to put a disability for a period of time and see what happens
Yeah,
if we have that disability versus if we have disability insurance in place to be able to cover that piece and what that costs us over the long run. And so we can look at some of those pieces. The biggest issue is we can look at it in a laboratory, but we have to
yeah,
step back and look at how we're really protected overall, because even when we look at it in a laboratory, what happens if you lost income across this time frame? Well, we've got a lot of other variables too. Was the market up or down when that happened? If it was down and we have to pull from it, the devastation is even larger than before. And I look
yeah,
at it as like momentum. So think about it with a car. Do you use more gas getting up to speed or when you're at speed and you're just maintaining? And so that momentum piece is really a killer. And I haven't run the numbers yet to see if the correlation is similar to, the percentage more that it takes to get momentum going versus just maintaining once you get there versus, having
yeah,
to stop at a stop sign and then pick it up again. The same thing that
yeah,
happens kind of in somebody's savings and investing over time, right?
yeah. Is there anything else that you want? Like, do you think when you looked at all the comments, is there anything else that you want to touch on?
I,
That
I, I think I think it's a place to start. Here's the thing: somebody can always beat up whatever we talk about because they can
Yeah,
always say, "Well, what if the market never went down and it stayed at 12% every year?" Okay, well, if it does, it's going to beat everything that's out there. Now, is that a likely occurrence? I don't know. But overall, I think the only thing that we didn't cover was the one person that said something to the effect of, well, you use the S&P without dividends. What if you use it with dividends? And that was the only time we used the S&P without dividends was when we were looking at an indexed universal life policy, which doesn't allow the dividends. And the reason on an indexed universal life policy we don't get the impact of the dividends is there's no actual investment into the market in an indexed universal life policy. All the index is doing is determining the allocation to cash, the percentage that goes of the growth based on what the S&P's growth was. And so that's the reason that piece is like that. But again, we didn't use that as a comparison of somebody investing actually in the marketplace. It was
yeah,
only to see what the index impact has on an index universal life policy.
yeah. I think that's well said. I'm gonna post our video that we did on retirement distribution. I think we did like 2 videos on that, and it's impossible for us to get into that in today's video of just like
Right.
the depth that we went. But we have videos that have gone through like just looking at retirement distribution, and so that's important to note, because if you can understand that and the discussion that we have, I think that will paint a maybe a more clear picture. And then I will say is, if you're watching this and you feel like you have a different perspective, you're welcome on the show. Whether it's with Todd and I or just with me, I would love to hear perspectives. I think one of the purposes of this channel is to increase IQ, financial IQ, and get people to start thinking differently. And I think part of that is the power of conversations. Todd, I've had 2 people so far that adamantly disagreed with me in the comments come on the show. We have not aired it yet, but both of them have at the end of the recording was like, "Oh, I totally see where you're coming from." Like the total perspective change, because number one, I don't think they're crazy. I'm totally understand the paradigm and the principles which they're highlighting. And so it's like, if we can speak to that and seek first to understand, but then we can also be like, "Hey, we're not crazy either, and here's why." It's I have never had someone not at least acknowledge that's like, okay, I get it. So I would love maybe to get beat down sometime, but it hasn't happened yet. But I welcome the conversations, and I appreciate you for setting up conversations that even get us to this point. Because if I'm not doing videos with you, we're not getting these type of comments and not drawing in potentially the viewers that are now exposed to something like this. Any final words or thoughts that you
Yeah,
wanna talk about?
sure. I think a big part of what we've talked about, just to kind of reiterate a little bit, is the importance of having a total picture plan, if you want to call it, strategy, that works under all scenarios or as many as possible. And that's critical, because if we make a mistake and we didn't cover a base, the devastation can be huge. And it's harder as we get older, because of time, being able to catch that up. And why nobody really likes looking at that big picture piece, it's so vital. And that's why it's so hard to understand how life insurance fits. It's that integration piece, is because everybody wants to do just the life insurance return to the best thing they can come up with, instead of a complete strategy that includes all of the pieces and parts and has a discussion around what happens if premature death occurs, what happens if a disability occurs, what happens if the markets don't do what we hoped they would do, all of that needs to be in there. And unfortunately, those things are hard to measure, right? And
Yeah.
you can't really put a rate of return on it, and yet the impact of it could totally devastate a plan that doesn't incorporate that, or a strategy that doesn't incorporate those pieces and parts. And so we really need to sit back and be open, as you said, to all the pieces and parts. Let's make sure that we're covering every scenario as much as we can.
Yeah. Todd, thank you. If you're watching this and you're like, oh, that's super cool to have a calculator system that shows you can add treasuries and bonds and different S&P and investments and blend them together with finding the actual rate of return when you factor in taxes and different scenarios. We'll have a link down below where you can find more information about Truth Concepts. If you are an advisor, if you're someone that helps people with money, I would highly, highly recommend you check that out. There's some really cool things that you guys are continuing to flesh out and making just being part of the community that you've built really, really important. And then if you're someone watching this and you're like, I would love to talk to somebody around what it looks like for potentially my financial life, or does life insurance make sense? We'll also have a link directly for you where you can learn more about life insurance. And if you want to have a conversation with someone on our team, we'd be more than happy to chat with you. Todd, we're going to continue our series. We're going to now go into houses, mortgages, velocity banking. So we're going to excited to hear some of the comments around that. And then I'm also looking forward to the continual content that we are making together. Thank you for making this a priority. And I always very, very much appreciate your friendship.
Well, thank you, Caleb. I really appreciate what you're doing, getting the message out there. I think you can fix a lot of the problems that people experience over time, and they're just devastated by it. Well, I had no idea this could happen. Okay, that comes from having a complete integrated plan that you have the ability to help people see.